everyone. Today is Thursday, December 23rd, 2021. My name is Evan. Welcome back to our weekly stock market analysis video where we break down the markets. We go beyond price action. We split up our analysis into two parts. In part one, we look at everything that went on this week in markets in terms of the raw data. So we go through correlations and volatility and sector performance, market internals, all the good stuff, and highlight everything that looks interesting or different. And then in part two, we jump into the charts. We look at price action. We look at those longer term trends and try and best position ourselves looking ahead. So hopefully that sounds good to you. We got markets closed tomorrow. So before I forget, because I can always get lost in these market videos, happy holidays. And I hope everyone gets to enjoy some time off from the screens and get to enjoy some time with friends, family, and enjoy these holidays. The stock market is closed tomorrow, so we've got the long weekend ahead of us. And when we think back, we look back to this week's trading, this holiday shortened week, we got a nice snapback, bounce back in equities. And the way I'm liking to sort of describe this is volatility to the upside. Volatility does work both ways. It cuts both directions. And in this case, we saw volatility express itself with a pretty furious upside bounce. We had a rough start to the week with that gap down, and we ultimately sort of held and bounced for the remainder of the week. We're going to talk more about that in part two. We saw oil also bouncing back aggressively this week, and just generally speaking, a very risk on week. So let's break it down here. If we take a look at the numbers, we can see that everything was firmly in the green here. We had the Russell 2000 and the Nasdaq leading the charge. Both were up over 3% in just 4 trading sessions. We saw the S&P up 2.25%, Dow Jones a little over 1.5%, and even world stocks, so outside of the United States, did pretty well this week as well. You can see the 1 month numbers now. So the 1 month returns for equity markets starting to try and get back into green territory here, namely looking at the Dow and the SPY, still waiting for the Nasdaq and the Russell 2000, and then what the world is doing to kind of turn over. If we take a look at market internals, so we've got still a bit of a mixed picture. So remember, this isn't a full trading week. So this is today's numbers. And again, today's numbers, I pull them early, so they're not the final numbers, so they could be off. But we have Thursday, Wednesday, Tuesday, Monday, and then this is last Friday. The week here is technically, week summation here is technically bringing in Friday's data. So a little bit sloppy on this table, but I think you understand the point. And the point is that we've been seeing some real sort of negative and bearish breadth underneath the market hood for basically the past month, 3 weeks, 4 weeks, 5 weeks, depends on how you want to count it. And we are finally now starting to just, flatten out a little bit here. And we're not really moving back to the bullish development confirmation upside yet, but we are starting to kind of flatline. And so it'll be interesting, of course, now as we move into the final week of the year and then into the new year, how we follow this up and how this trend ultimately develops. So if we go here to this slide, you can see this is the 52-week highs minus lows over the past 30 days. And I'm just taking this in aggregate and summing up the net movement. And you can see right now the net movement is a trend to the downside. So we still have this effective downtrend in the number of stocks making, in this case, 52-week lows. More stocks making 52-week lows over the past 30 days. You can see here how we are starting to now, bounce up a little bit, right? And if you could think of this in TA terms, which again, I'm looking at this more as just the bigger trends is how I like to analyze this. But the question you're essentially asking yourself here is this a bear flag, right, in market breadth where we sort of, rise, maybe get back up to negative 1,000, and then suddenly we break down and then start trending lower again? Or can we actually stabilize here, and can the market and can participants, can institutions come in and support this market and not sort of continue to cascade us lower? That's the question. And that's why we do these videos every week, is because we want to stay on top of the developments here. So I don't have a crystal ball. I can't say what definitively this is going to go in which direction, but I am a fan of betting on trends. Right now, the trend is down. So for me, this is still a pessimistic chart. So that's the way I'm sort of looking at it. A little bit of stabilization this week, but I'm not willing to say this is the bottom here. I need to see more evidence before I get that excited. If we take a look at sector performance, you can see beautiful week. Everything here in the green this week. At the top of the list, we had consumer discretionary, we had technology, we had communication services. This is a fine bunch here at the top of the stack. So a nice sort of risk on rally. And on the downside, utilities, real estate, consumer staples, again, a very fine and orderly sort of stack of the more defensive areas of the market. So really, when you look at sort of, again, just this risk appetite, this was a perfect week in terms of what was moving, what was lagging. If we move on here to correlations, you can see we've got lots of things moving together right now. Lots of bright green on this chart right here on this table. So you can see, for instance, in this top left, this whole block up here. So this is just all of the major indices. So the Dow, the SPY, the Nasdaq, the Russell, international stocks, everything's moving clustered together right now. So there's not too much separation between small caps, large caps, or anything in between. We've got just broad risk appetite equity markets all sort of moving lockstep with one another. And you can even throw oil in here, which we've seen this very tight correlation to what oil's doing, trading right alongside of the major averages risk appetite. And that continues to be the case right now. And then take a look at the US dollar here. And to a lesser extent, we've seen the correlation break down a little bit on the treasury yields, but you can see that the US dollar, which in fact was something that we thought last week was poised to actually move higher, it actually pulled back this week. It was the exact opposite. So it was primed, it was consolidating, it didn't break down, but it certainly didn't get the breakout that it seemed likely to do. And King Dollar, again, helps, or I shouldn't say helps, but really can dictate and drive lots of other cross asset movements. So when you see the dollar unwind like it did this week, I don't think it was that much of a surprise then to then see lots of different things like equity markets begin to rally as the dollar starts to soften a little bit. Now, again, we'll continue to track this. These are 10-day correlations, so they are inherently short-term and noisy. But again, this helps us just understand narratives that are moving together. And we track this week over week. If we take a look at VIX here, volatility, you can see this is moving down here. So the blue line represents this week, the term structure volatility, term structure across this week's worth of trading. You can see we're back below 18 for the VIX. I do like that. That is something that is a level, generally speaking, a line in the sand that I like to use for VIX. And the fact that we are finally now back into the teens here, we're starting to kind of roll over. I do like that in terms of constructive overall market sentiment or market positioning. So that was encouraging to see us dropping back below from the front month here, north of 20 down to 18. If we take a look at interest rates here in credit markets, you can see that yields were up across the board. That means bond markets or bond funds, TLT, IEF, SHV, all those types of bond proxies were down. And we also see credit markets here, investment grade bonds, high yield bonds, hanging in there for the most part, not really giving us too much of a signal or worthy attention grab at this point. If we take a look here at the dollar and commodities, again, we talked about the dollar just moments ago falling this week. So it was down 0.7% this week. It's a big move for the dollar index. And you can see basically everything else rejoicing here in terms of commodities and, Bitcoin, crude oil, natural gas, agriculture, everything working itself higher this week as the dollar falls. So put it all together, we've got the best report card we've seen in probably a month at least, as far as I can remember anyway. So we've got an A- across the board. Basically, check marks are there. Market breadth is still suspect. We talked a lot about that at the beginning of the video. So we've got a solid A- here in terms of the report card. If we finalize here with the two trading systems that we are running here at trade risk. And this is where, again, I personally allocate about 90% of my equity market funds to. And this is, actually this brings up another interesting point. So, I had I had several emails come through about my positioning here on the markets, or saying, wow, you seem pretty bearish out there in terms of your market analysis, Evan. And that is, I think undoubtedly the case. I agree with that. I have been more bearish on the market, continue to be sort of glass half empty here on the market. But I always show this slide every single week because this is actually where my dollars are allocated. And so even last week, when I had personally, Evan, me as a trader, have a negative outlook on the market, and I dislike the overall market environment, last week I was still net marginally long based on these two trading systems, right? So I wasn't 100% short the market. I had a very more neutral stance, but I wasn't, full in the bear suit in terms of the allocation. Me as the trader analyzing the market and the information that I'm seeing, much more pessimistic than the positioning here. So ultimately, I invest with these fully rules-based trading systems that I've created, and I don't argue with them, right? So this is kind of my expression here of where my dollars are actually voted, and they're always shown here on this slide. So you can always kind of see, what's the objective market analysis we're talking about, what's Evan's maybe little bias in there, and then how is his money actually allocated. It's all here every week, very transparent for you to sort of track. And sometimes those things are slightly different. So I think that's an important note, and something maybe worthwhile to mention here. So if we take a look at these systems, you can see this is our longer term system. So this is Merlin here. This invests over the next month or two. And you can see that it continues to sort of build this cash position. So this is, again, just sort of de-risking in the market here. It never got short, right? It never even got close to 0%. I mean, this is the most pessimistic it has been all year, which is 49% invested in the market with a 51%, cash that it could put to work. So you're seeing here, again, still something that is staying with this market, but it's been raising cash, continues to sort of do that throughout this week as well. If we take a look at our short-term trading system, this is now net short going into the weekend. So this was net long last week. It was long at the beginning of the week, and it essentially was scaling out of the rally throughout this week, and it was increasing its short position. So you can see it's going into the week and a little bit net short. So both of those trading systems, lots of information on our website about them. If you want to follow along, if you want to read the trade reports that get issued nightly, you can sign up for a trial and check it out yourself. So that's what I've got for part one. We'll be back here in just a moment with some charts. We are back. We've got Warden TC2000 open. We've got our equity market grid showing. This equity market grid has a custom smart trend filter that we've developed. That is the multicolored dots you see on these charts. It measures price and volume across time, and it helps us determine trend strength, path of least resistance. And then the white dashed lines you see on these charts are price itself. Price series itself expressed as just a line chart, and we're looking at a weekly time frame. So when we look here at a weekly time frame, we had a couple of changes in the overall outlook. A lot of it stayed the same, but there were a couple of things that changed. So first is the S&P 500. Take a look here that we are getting this oscillation going on here on the S&P 500. So we went back to a green outlook, bullish outlook, fresh buy signal last week. And yes, even though we rallied 2% this week, we actually got a yellow print here on the S&P 500. So that's a little bit interesting, shows that trend is definitely still up. We give the benefit of the doubt to the prior signal, which in this case is buy, or green or bullish, but we are still gonna, notice the fact that we are in this yellow sort of transition mode here for the S&P 500. So That's the first change. If we look at the Nasdaq, this is still yellow and transitioning here. So again, despite 3% move higher, we're still kind of hanging out here. This indicator is recognizing there's some cross currents, and that still is the picture. And the Russell 2000, which, man, I thought we would finally get that red sell signal, the first red produced sell signal for the Russell. I was anticipating it would happen this week, and it just didn't happen. We got this strong snapback rally, and it kept it in this transition phase, which is, really a nice testament to this indicator, because after all, this is a trend following indicator, and it is very easy to get whipsawed in these trend following type indicators or signals or strategies. But if you're looking at something like this has just been recognizing this indicator all year long, that there is trendless direction here. There is no direction, right? And so that continues to be the case. We are failing to break down. We're failing to break out. We had this brief period in here late in October, early November of a potential breakout move, but it certainly gave way pretty quick. And here we are back into that chop zone. So Russell's there. ACWX, bottom right, international stocks did produce a fresh sell signal. Remember, it did this way back here in early October. Didn't last long. And, we're going to see it again here. Despite the 2% rally, we got a fresh sell signal, and we'll see if this continues into the end of the year and the start of the new year. Now, let's go down to a daily chart, right? Because all of these trends can be analyzed on multiple time frames. So that was the long-term time frame. If we go down to the shorter-term time frame, we can see that we've been very messy here in pretty much all these markets. Everything's been printing essentially warning yellow signs or red signs. And if we look at the S&P 500, we got a fresh buy signal produced here on Thursday. So again, a nice change of direction here in the S&P 500 daily chart. Nasdaq, no change, still neutral. And we're going to wait to see if that trend can change early next week. And the Russell, still neutral. Both of these markets have prior sell signals on them. So again, it's still kind of glass half empty there in the Russell, in the Nasdaq. And then the same thing in international stocks. You can see neutral, but prior signal is a sell signal. So that's the trend analysis. That's the objective price volume. Where are we and have we been moving type of analysis. Let's go down to some candlestick analysis. Let's get a little bit tighter here on our levels. Here's the S&P 500. Here's how it finished out the week, back to knocking on this resistance zone. Objectively, though, closing at fresh new highs. We have a 47.25 closing print here for the S&P 500. That's good for new highs. Throw on a weekly chart. You've got here a bullish engulfing bar that just made new highs here this week. Now, a couple of things. First off, yes, the volume is low. I think there are lots of people that are going to be pointing to this rally that is occurring here on light volume. There's obviously, some merit to that. Now, here's the thing is this time of year, as we get into the holidays, as we get to the end of the year here, generally we see volume taper off. This is what we might expect seasonally during this week. So I am not going to think too critically about this. I don't want to hang my hat too hard on the fact that it's lower volume. I think it's a fine thesis to have, but ultimately this is the time of year and price is, moving higher and now closing at highs. So I think we need to respect that. Now, we talked about the narrowing sort of leadership and market breadth out there. We saw, we talked about some of the concerns and maybe the volatility complex and the different sectors. So there are lots of things that are still keeping me glass half empty on this market. But if we're going to be a risk manager here, we have to respect the fact that price is back at these highs. And if it continues to move here, this is not a market I would want to be short, right? So I may not like the market, right? I may not want to be eagerly buying the market. I may not want to be 100% long the market, but I don't want to short a market that, is trading at all-time highs during low volumes. That is a very dangerous place to be. Probably done it many times in my career. So again, this is where, having an opinion on the market is fine, and, managing risk on that opinion is very important. So That's a long-winded way of saying, may not like the market, but let's respect what price is doing here, and it is closing at highs. So next week, what I would be paying attention to is, can we follow through to these highs, right? Does this market get some legs here, or does it fail abruptly? Those are clues and context. It's exactly what we talked about the other week when we had the S&P 500, I forget where it was, but it was, falling back, pulling back into here. And we essentially said, look, I want to see what things look like around, 4,500. If we can get back down here, does the market hold? What do market internals look like? What does the volatility look like? All of these things would be clues and context as to maybe what's going on under the hood and how weak we are. Well, it's really the exact opposite. So we got our information here. We know that the market held. We know that, market breadth still isn't that great, but we did get that bounce and we're back at highs. And so now we're doing the same exact thing. We're saying, okay, well, can we continue to see breadth improve? Can we continue to see volatility come out? Can we continue to see the right sectors lead? These are all the things that we now want to see, because we could see price pop back up, then start to consolidate. Maybe market internals start to firm up. Maybe some of those divergences and downward trends that we're seeing under the hood of the market start to resolve themselves back to the upside, and we can rally. That is an absolutely perfect sort of scenario here on how we can move into the month of January. So we can have opinions. We don't want to be, too strongly held to them. We don't want to be dogmatic here. We want to let the market essentially dictate its path and its intention. So that's really kind of the framework I'm using here for the S&P 500, 4730. I'm still a little suspect of it personally, if this breakout can get some legs, but I'm willing to be wrong and adjust and, essentially take the bullish side here if the evidence stacks up on the upside. So that is really what I'm paying attention to. This range that we talked about, if we want to really sort of simplify it, again, back to around 4,500, let's call it, to exactly where we are right now. This is where I think things are interesting. We're at the top end here. We're at the inflection point. Let's see now how the market follows this up. And don't forget, we did just now bounce 3 days, pretty strong here. And, we're in a little bit of a chase mode. If we take a look at the Nasdaq 100, you can see we're basically at, again, the top end of this range. We have been identifying this area here. I think this is an easy way, an objective way, right? An impartial way to sort of look at prior supply and demand levels. You can see these support areas continue to stack up around the lower 380s. We've got the resistance here around 399. Let's go back to the S&P 500 just to show you what this looks like. So again, here we are right back into this resistance zone. I don't use any of these levels as super precise, accurate to the penny level. These are all drawn with some pretty thick crayons. So that's kind of the way I'm looking at this. The cues back to this upper, kind of resistance area where it has previously failed many times. We can see the volume's a little bit lighter, and we're going to want to see how this, how this handles up here and what the reaction, what the tempo is going into next week. We did test this area. We briefly undercut it, right? So we made a low all the way down to 377 back on Monday of this week. We held, we reversed perfectly at support. We bounced pretty aggressively now. And so where do we fall now? Where do we go now? That's the question. That's what we're looking for as we're back towards this inflection point. Last but not least, the Russell 2000 bouncing again, undercutting all of this recent sort of, little support that we carved out over the short term. If we zoom out here, we got a 210. Just let's see, did we get 210? We got under 210, right? 208.76. That was the low print here for the Russell 2000, which is basically the year-to-date lows. Well, not quite, because we did rally, but the year-to-date lows of this range. And again, a nice aggressive bounce here. We're back into the middle of this range. Still basically means nothing from a structural perspective, but we did hold those lows, and we do see that MACD, bouncing aggressively. So there we have it. There's the bounce. And now we're going to be paying attention to the follow through, the context, the clues, and a lot of the under the market hood action. So that, I think, really, kind of illustrates my thoughts there on the major markets. Again, risk manage appropriately over any opinions that you hold about the market. I think that's very important, especially during these light volume, periods. So let's go to VIX. Take a look at the VIX here. So we can see the VIX fell comfortably this week. It opened all the way up to around 27, put in what appears to be now looking like a lower high to last week's above north of 30 pop that it had, put in a bit of a lower high around 27, and now here it goes falling below 20, below 18, and this is, again, I think constructive here. If we can continue to fall, continue to hold down at these levels, I do like that, and we're going to continue to see if that can, essentially regime change back into the 16 to 18 range for the VIX. That would be a positive sort of development there. We talked about oil at the top of the video, had a big bounce back this week as well. You can see 4.63% opened the week pretty horribly, but it put in a very strong bullish engulfing bar. Again, the volume was pretty weak, but still nice kind of snapback here and stance by the bulls, rallying nicely here on the week. We can take a look at TLT, long bond, kind of fading a little bit. IEF, we talked about interest rates rising. IEF kind of failing a little bit. We got gold, which is rallying here and, continuing to kind of firm up. So I did do some buying. This is a separate account, a defensive account, really where I'm almost managing like a cash conservative position. But I did pick up some gold this week. Throughout this week, and for the first time, I haven't touched gold in a very, very long time, and I do think that it is, poised here to maybe have some type of nice move in the first half of next year. We'll see. Jury's still out on that. I'm not necessarily trading that though. It's not, trading all that kind of stuff. It's more of a allocation in a long-term kind of safety account that I have. But I did do some buying of this metal, and we'll see if it can, work higher throughout next year. So I think that's it. I think that's all I want to talk about in terms of majors. Let's take a look quickly here at our sectors of interest. We have only on the upside this week. We've got a small list, but we've got some REITs. Let's go to a weekly chart. Get some REITs here, breaking out, closing at new highs. So that's constructive. Not quite all-time highs, but starting to resolve this little range. We've got computer systems. So in the tech space, this is a nice little breakout here in tech sector, computer systems specifically. So this is looking at an industry. So here is the components within this. So there's 31 stocks that make up this index specifically within TC 2000, although I'm sure there's lots of, other platforms that would group these stocks within computer systems. So that's the list there. You can look at some, familiar names like Logitech and HP and Dell and, many other names in here. So making new highs. We've got Apparel Manufacturing. Now, this is interesting to me because I don't know what this is. This is definitely probably a top-heavy index that was dominated by one particular name. Now I'm sort of curious to see what the heck that print was. Let's see if we can find it real quick. Oh, yeah. Is this it? That's the entire index. Okay. I'm not sure what drove that. Oh, maybe, what is this? So maybe an addition here, this ZGN coming in. I actually have no idea. If anybody has any insight as to maybe why this performed so strongly this week and why this print looks like this, let me know. Almost looks like a off print here because the volume is still very light, 58% return. Not too sure. So there you have it. Pollution and treatment, nice reversal stance here. Good volume coming in. Utilities breaking on out, looking pretty strong here. This is specifically independent power producers. We have insurance brokers, very heavy volume coming in on this holiday shortened week. And last but not least, we have medical distribution. Medical distribution also working itself to new all-time highs. So there you have it. That is the sector rundown. That is the market analysis rundown. Hopefully it was helpful for you. As always, I want to thank you for tuning in and watching, and have a great extra day off, time to yourself. And don't forget, if you like these videos, do subscribe on YouTube or follow us at The Trade Risk. That's where we're always posting everything. And we'll be back next week with more market analysis into the end of the year. So thank you so much. Have a great holiday, and we'll see you on next week.